Welcome back. Video 3, our final video for Chapter 14. And this is another recording of bonds payable, the issuing, and also it matures in this one. This one is at a premium. It's also on page 792, just like the last one at the bottom of the page. It's 14, that's supposed to say 42. And I didn't put the 2, sorry. I erased the 40 and put nothing. 42B. This one is January 1st, 2018, Electricians Credit Union issued 8%, 8% again. That's they quote the annual rate, so of course we're going to cut that in half for semi-annual payments. And this is 20-year bonds, so it'll be 40 payments, right, of the 4% every 6 months. And they're payable, the face value is payable in 20 years of $400,000. They're calling it face value here. They call it different things, but face value is one of their favorites. That would be the maturity value, the second stream of money they get at the end of the term of the bond. The bonds pay interest June 30th and December 31st. That's very common throughout the chapter, those 2 dates. The issue price of the bonds is 104, which means they sold for 104% of the face value. So they sold at a premium. Anything that sells over 100%, that means the company is paying more than the market is paying in general. So the bond, in reality, very few bonds sell at a premium. They almost all sell at discount, almost all. So this is a very unusual situation, but not in books. Happens all the time. So they want us to journalize issuing the bonds, payment of interest and amortization, both June 30th, 2018 and December 31st, 2018. They're going to look exactly the same, and if we had to do the other 38 of them, nobody wants to do that, but if we did, they'd all look exactly the same. Okay? We just have to do 2 of them, and then we have the maturity date as December 31st, 2037, right? 20 years into the future, when they're actually going to pay that principal or face amount off to their bondholders. So it's a pretty simple problem, but I wanted to include it just to show you the premium side of things. So on January 1st, 2018, we have the bond, and they received $416,000 because it sold at 104. When you see 104, 79, 85, like the last one, that's a percentage of the face amount. Okay? Or the principal, it's sometimes called. $416,000 the company got for it. Premium notice, we call it an adjunct account because it increases on the same side as the bond, the credit side. Premium on bonds payable, the difference between what it sold for and its face, $16,000. Bonds payable, of course, is at $400,000. That's this entry right here. And here's our premium. I posted it to the T account. 6 months later, they get the first interest payment. Notice the reduction of interest expense per the books. When you record interest expense and you have a premium situation like this one, interest expense is actually going to come down. In reality, you're still paying 8% or half every 6 months, 4%. You're given $16,000. But you can only take credit for $15,600. You have to subtract each amortization every time you do a payment. Okay? Notice the premium on bonds payable. Oh, yes, I have it. Yay. June 30th, 2018 is our first amortization of the premium using our straight line amortization. And our cash. Again, 8% divided by 2. I just do the 4%. You'll notice the book is always going to have the full annual rate times 6 over 12 or times 1/2. They like to do it that way. Same exact thing, December 31st, 2018. Again, we could do 38 more. Nobody wants to. Interest expense again at $15,600. The premium gets its second amortization. There's going to be a lot of this as it moves on because there's 40 payments. It's for 20 years. Is our cash going out again to our bondholders? So we're going to assume here that the 20 years have gone by and they held the bonds to maturity, right? They didn't sell them, or the company didn't buy them back. It wasn't a callable bond. Okay? It was a term bond held to maturity. So 20 years later, December 31st, 2037, they're paying the principal or the face amount. The bonds are going to be done. It's going to be fully amortized, right? The $16,000 will be gone at the end of the 20 years. Bonds payable will get debited to eliminate that liability. And the company has to shell out the principal of $400,000. So again, debt can be very useful, and we saw that in the leverage problems within the chapter, that debt can make the company more money than stock actually, but it's riskier because they have to pay this. This is a bill that they have to pay. Unlike dividends, which you don't have to declare if you don't have a net income. So it's kind of, it can be iffy for companies. And they like to have a way out many times, so a lot of companies issue callable bonds rather than the full term bonds, but it varies. So this is a premium problem, a nice short one. I thought you'd appreciate that. And that's it for this one. And if you have any questions about anything in chapter 14, just let me know. We'll see you next time.